How does supply come into the market? If you've got a bunch of young pretenders, as it were, juniors who have got an asset, not necessarily a great asset, and not necessarily the cash to be able to do too much about it, but it is uranium, so people are getting excited about what that could mean. Do you think that all uranium juniors currently in the marketplace are going to survive because of this price recovery which people are expecting, or do you think that it's going to move in small increments, i.e. the lowest cost producers who can create a margin for themselves whilst the price recovers are going to be able to step up to the plate first? And what indeed does that mean for the people who need 50, 60, 70 bucks?
That's quite a question.
It's a long one, right? Are there going to be winners and losers is what I'm asking.
There's some tremendous uranium projects in the Athabasca Basin. They have an issue with permitting timelines and capex. So I don't know how much money would be available to build a project that potentially is not going to be permitted for 10 years. So, I think what people have to look at right now is who can actually come into production in the next 2 to 3 years that could actually start supplying the utilities when their contracts run out in 2 years. The big high-grade projects won't be there. There's some smaller producers, some in-situ leaching in the United States. That's 1 million pounds, 2 million pounds a year. It's small scale. So, I think aside from Cameco turning on production at $35 to $40 a pound and Kazatomprom doing the same thing, the new projects, there's going to be very few that actually make it in this cycle.
Okay, so in this cycle, see what intrigues me, and what we talk a lot, right? What intrigues me about you guys, and I think from what I read, people appreciate your business model. And the business model being you've also got a zinc revenue stream component with your Turkish JV, Befesa. Now, that's going to help because it means that you're not going to dilute shareholders continually. There's the ongoing income stream there. Now, you have made a couple of statements recently with regards to that, because obviously zinc price has been hit a little bit. So you're putting out the timeline there somewhat. Can you just tell us about what's going on in Turkey first of all? Are they still working? Are they still able to operate?
Yeah, good question. Turkey is still working. Of course, the government has imposed some protocols that everyone is following. Where we are in Eskedron, it seems to be virus-free at this point in time, but we are using, very specific protocols to keep people away from each other. The plant, of course, is brand new. So it was just commissioned in Q4 last year, 2019. So, it's a highly automated plant. So you actually don't need a lot of people there. And, so it's still running at capacity currently.
Okay. So, but in terms of the statements you've made, you said like there was a sort of 12-month payback period, but obviously zinc prices have been, a little bit lower than they have been. Yeah. That's going to take a little bit longer. Can you give us an idea of the timeline there?
Yeah. So when we started the plant, the zinc price was between $1 and $1.10. As a result of the current market conditions, it went down to 85 cents a pound. So what we're telling people now, rather than a 1 year payback of our capital there, we're talking about 2 years at this point.
Right.
So, the dividend stream coming from there, we get monthly management fees and sales commissions that effectively cover a lot of our G&A in the company. But the big dividends that are typically awarded once a year after the AGM, they would start later than we expected.
But that is quite a long and annuity stream of cash for you.
Well, I mean, the plant will be running for the next 50 years, I would suspect. It's a brand new plant, so
I'll put that down and say yes. Yeah.
Yes.
Okay, right. So that's the sort of interesting part of the business model. But let's come to maybe your PEA, because I think it'll allow me to understand better where you're positioning yourself in the market. Because there's some clues there. You're talking about getting in earlier into the cycle than some. So why don't you give us the big numbers on the PEA? Tell us what you announced this morning.
Well, this morning we announced a phase one mining project at our flagship DASA project in Niger. This is a 250 million pound deposit. And over 2019, we did a lot of trade-off studies on how it should be mined. Open pit, underground combination, startup underground, then open pit, or vice versa. At any rate, what we've been able to achieve here, and with money actually that was provided from our Turkish operation, we did a big round of drilling, and we defined an area we call the flank zone, which is a high-grade section of the deposit that comes close to surface. And so what we've laid out here in this PEA is a ramp access underground mine that is basically mining about 5,300 or 0.5% uranium. And if you notice in the press release that the majority of the pounds, there are about 30 million pounds of the 48 million pounds we'll be mining out of this flank zone, is running at over 1% uranium.
Right.
So the average grade is about 5,300 ppm, which, for an African uranium project is outstanding. It puts us more in the Athabasca style deposit at, 1% plus there for most of it. And it obviously then doesn't require a lot of tons to make a lot of pounds. So we've engineered 1,000-ton-a-day operation that's going to produce about 4.4 million pounds a year of yellowcake. At an all-in sustaining cost, of course, below $20 a pound. Our cash costs are about $16 a pound.
I mean, that's the remarkable number there. Being able to produce at less than $20. I know you have said it before, but I'm not sure the market believed it. And you're saying that is achievable. I mean, the other thing that stands out is we knew this was a big resource. The available pounds here in terms of, I presume, phase two, it is huge.
Right.
But this project on its own at $35 is showing, you're indicating here, what, 26% IRR at $35?
Yeah, that's after tax.
So yeah, that's a nice number. You must be happy. Were you expecting this?
Oh, it's great.
Were you expecting it?
Well, I think when we started working on the model of the flank zone as an underground high grade operation, the numbers started coming in because the resource there is so good, and it leads you into the lower sections of the deposit where there is also a lot of good high grade material, but of course it needs to have more drilling, which you would do during your mining process. As it says in the press release, we'll use this phase one to actually produce uranium quickly, but also to develop the rest of the deposit.
Okay. And the thing that interests me is, again, the business model. Like, some people would say, well, do it all in one go because it's a much bigger resource, and therefore it's going to be much more attractive to big players, etc. So why are you doing it this way? Why get into production early? I assume is to hit this cycle. What you were saying 5 minutes ago.
Well, Matthew, at the end of the day, we're a mining company. We like building mines. I think with uranium, and obviously you can mine this at a much larger scale. It's going to take more capex. Like, we came out with our 2018 PEA that showed, 300 million capex doing twice as much production on a much larger scale. But the grade was lower, the capex was higher, and for a junior mining company, it was just too much. The other thing to consider in the uranium business is you don't want to come out there with a an 8 to 10 million pound a year project, because where are you going to sell it? So what we want to do, and we think the sweet spot is, between 4 and 5 million pounds, is just exactly where we came in. It's a marketable amount of uranium. 2 or 3 utilities could take that up every year, and you don't have a huge issue moving your product.